Welcome to the Juggling Mind and Money podcast with Steve Rowe and Jessica Schlupp-Taylor. Steve Rowe is the founder of Lucent Financial Planning and an award-winning independent financial planner. He helps you to use your money and have a great life. Jess Schlupp-Taylor is a psychologist supporting people through change, challenges, and forks in the road of life. Together, they will help unblock the sludge in your mind, stopping you from achieving financial and psychological happiness.
Hello and welcome to episode 27 of Juggling Mind and Money. I'm Steve Rowe, founder of Lucent Financial Planning, and this is Luke James, chartered financial planner, and he's here instead of Jess because today we're going to talk about the budget.
Ooh.
I expected more of a dun dun dun.
Yeah, I don't know what I was trying to do with that noise. I lost it at the end, but there you go.
It sounded a bit sort of sexy, really.
Yeah, ooh.
Ooh, nice. Now, let me tell you, ladies and gentlemen, no budget is ever sexy. It's normally incredibly boring. But there are a fair few changes this year, so we're going to go through it. Mm-hmm. This will be released on the 4th of December, so a week after the budget. So some things will, again, have come out that we might not have been aware of yet. So we're going to look at the main changes that will affect our clients in their financial planning space, rather than some of the things that don't, because that's boring and irrelevant.
Agreed.
Okay, so Luke, you love a budget, don't you?
My favourite time of the year.
You were sat there watching the telly, you had some popcorn, you had the telly on.
I did, yeah.
Rachel Reeves was reading it out, but obviously it had already been accidentally released.
Yeah, that's it. Yeah, exactly right. Every year we look forward to the day. To be fair, Steve, I think we do kind of look forward to it, and the reason is because the months leading up to it is just everyone trying to guess.
The rumour mill.
Yeah, and so when it actually comes out, at least we know then what it is, and we can stop guessing, stop trying to work out what's going to happen.
I'll get a bit sick of this, to be fair, because every year, because the papers, they need to sell papers, so they're not going to put something like, oh, well, hardly anything will change.
Yeah.
Because that doesn't get clicks or, no one buys them anymore, do they?
That's it. Whereas tax-free cash being cut, everyone's going to click on that, aren't they?
Yeah. Chancellor coming after your money.
Yeah.
Makes you look at it and reading it.
Exactly right.
And then, what are the knock-on effects to that, Luke?
Well,
for your poor financial planner that has to deal with this.
Yeah, I was going to say, you're talking about for us. Well, I mean, it creates loads of unnecessary work for us because we're trying to get people to stop making a mistake. And that's difficult when you don't know exactly what's going to happen yet. But also, so many people this year will have, again, made a big mistake over the budget.
Not with us, mind.
Not with us, because we're
but
kind of the wall between that, you and your mistake. But so many other people, especially people not getting advice, that's scary stuff, isn't it? So that's a really common one. Happens every year. People whack a load of tax-free cash out before the budget because they're terrified that it's going to be cut. It's not, or they put in some sort of protection if it is, and you've lost out then.
So one example of that, if you'd taken your tax-free cash, so we've done that for people that are going to get it in the next year anyway.
Yeah,
because it's not a big deal, is it?
Mm-hmm.
But for people that say it's 5 years before they needed it,
yeah,
that's tax-free growth in a pension they've missed out on.
Yeah,
and they might have put it in a general investment account because
mm-hmm.
you want to keep it invested. How does a general investment account work tax-wise?
So within there, if you get paid dividends within a general investment account, that's taxable as dividends. And when you sell investments or assets within there, it's taxed as capital gains.
Whoa. Hang on. One of the things in the budget is the dividend rate's gone up. I do sometimes wonder, whether the government doesn't put these rumours to bed early because it benefits them. So in last year's budget, there was lots of rumours about the capital gains tax rate being increased to income tax rates levels. So last year it was 10 and 18%. That's gone to 18 and 24% now. But there was rumours it was going to go to 20 and 40%, depending on what income tax band you are. So there was record withdrawals and cashing in of gains then. So they got loads of money because of the rumour and not because of what actually happened.
That's it. Well, at the end of the day, they're the only people that win out of that.
Well, we win. That's not very a good
What do you mean?
statement because it's our country.
Yeah, okay.
You know, so whether it's right decision or not,
yeah,
you know, it's for the benefit of us, supposedly.
Yeah. That's it. Yeah, it depends who you ask on that one, I imagine.
Yeah. Well, you know, if you believe
in
the big, you know, the faceless corporations running the world. What's that called now?
I don't know.
That conspiracy theory.
I don't know. You talking about the lizard people or?
I don't know, something like that.
Yeah, Illuminati.
Yeah, that's it. Yeah. So if that's happening, anyway, we digress. Which, for new listeners, that is the whole premise of this podcast: to digress. Alas, I digress from my digressions. So let's get back to it. So rumours, that's not great.
No.
And it's not great for our listeners either, or for regular people that are trying to have to decipher this when it's been battered into your ears and eyes every day.
Yeah.
Because it makes you feel like you should do something.
That's it.
But we think you should only make decisions on fact.
Yeah.
And
agreed.
that's a fact.
That's it. But it's really difficult. It's easy for us, right? Because we are emotionally invested in our clients, but we're not emotionally tied to making that decision. So we can look at it, look at the facts, work out what we think is best. Plus, we've got a bit of knowledge backing us up. And then we can then make an objective decision of what you should or shouldn't do. But when it's just you doing it yourself, that is difficult. It's tied to emotions. You've got your own biases from childhood onwards about money and making decisions and worries and not wanting to mess it up. And then when you get hit with headline after headline, you know, it's natural, isn't it?
So it's really hard. Life's really hard, right? And most things in life, it's best to do something and make a decision. But I think with money, it is best not to.
Yeah.
You know, if you got a rule of thumb without knowing anything else, do nothing is probably the best option. Very much like on a Sunday. You know, if you don't know what to do, just do nothing.
Yeah, that was me yesterday.
Yeah, probably have a nicer time.
It was great.
Stop giving away the day we record this podcast.
Oh, sorry.
Yet again.
The other day.
Jess did that last week. Anyway. Okay, so rumours, they do get on your nerves, but we've got to try and ignore them, go to a happy place and forget about it.
Yeah.
And then when we've got the facts, which we have now, sort of, because facts are only released slowly as things come to light and things are thought through more, then we can make real decisions and do something based on what's actually going to happen.
Exactly.
Which is good. Right, we're just going to take a small break now, hear from our sponsors, and then we're going to come back and talk about what actually happened.
And now a message from our sponsors. Jess, Steve, there are no sponsors. This is embarrassing.
Hello and welcome back to our special episode on the budget. It's Steve Rowe here, founder of Lucent Financial Planning, and Luke James, Chartered Financial Planner, and we're discussing the budget. So now we're going to look at what actually happened. So this isn't everything, because, you know, there's like 200 pages of stuff. This is the stuff that we think is most likely going to affect our clients and the people that are likely to listen to this show. Okay, so I think the biggest thing, Luke, is the that affects pretty much everyone, but only from April 2029 is the salary sacrifice cap. So could you explain what salary sacrifice is and also what the cap means?
Yeah, so salary sacrifice, as the name suggests, is where you sacrifice part of your salary, in this case, to pay that money into a pension. It can be done with other things. So if you kind of think, if you earn £50,000, and through salary sacrifice, you sacrifice £5,000 a year. Then for, all intents and purposes, you earn 45,000, and that extra 5,000 goes immediately into your pension. So if you hadn't have done that, when you got paid it, the money would have been taxed. So you'd have been 20% down in that case, plus national insurance on top of that. Now, the beauty of salary sacrifice is all of that tax relief, essentially, you get it immediately. You sacrifice the money, all of it goes into the pension, no national insurance and no income tax. Now, what's been set out in the budget is from April 2029, there's effectively going to be a cap on that of £2,000 a year, which means anything over that, there's going to be national insurance to pay.
So just to be clear, this is, you still get the income tax relief,
Yeah.
which would be 20 or 40% into your pension.
Yeah.
It's just the national insurance. But the national insurance is your personal national insurance, which depends what you earn,
Yeah.
the rate you pay, but also the employer national insurance. So they would pay 15%. Now, if you've got a good company, they might sacrifice some of that 15% saving to you. Say, look, we're going to gain out of this. Let's split it.
Yeah.
So you might get 7 or 8% of that saving from your employer as well. So that's going to be eroded now. And if you look at £2,000, say you've got a typical sort of 5% employee payment that you might sacrifice, that's on £40,000 a year, which is slightly above the national average earnings. That's your £2,000 cap.
Yeah.
So this is pretty normal. And anyone else wanting to save a bit more than that, it's going to cost a lot more in national insurance for them and the company.
Absolutely. And that's coming in from April 2029. And let's assume that £2,000 stays the same. Salaries and income should go up over that time. And so you'll find a lot more people getting caught out by this. I think this is something perhaps, it caught the headlines for us. I don't know if this was the main headline out in the press, but this is huge. This is going to make a massive, massive difference to people.
And it will make a difference, but because the majority of it is pensions, and we're going to look at this later, that's in the future. So they won't necessarily see it directly in their pocket, because you could adjust your pension payments downwards accordingly, so you end up with the same amount.
Yeah.
But that's going to affect your whole future once you're retired.
Absolutely. And it's going to affect the way people view paying money into a pension. The whole reason these things are set up is to get people to save for the future, because we're going to talk about later, that's really difficult to do, thinking 20, 30, 40 years in the future. So these kind of incentives are there for a reason. So people build up more money in their pensions in the future because people don't do that. So this is a big one, I think, and it's going to have big impacts on people's retirement.
I do also think, though, because it isn't for everybody, so it's only if your employer could have been bothered to set it up as salary sacrifice.
Yeah.
And a lot of companies can't, because it's a bit of extra administration. So especially smaller companies, where the admin costs would be more than any national insurance saving.
Yeah.
Okay, so that's links actually to a nicer one, since you were another piece of information. So again, higher rate income tax thresholds and the personal allowance have been frozen. Is it another 3 years till 2031? So that'll bring even more people into the higher rate tax threshold. I think it's 1 in 4 people will be in it by then.
Yeah.
At projected inflation rates.
Well, that's it. And if you I think I was speaking to somebody about this the other day. And kind of when you factor in how much of a difference that's going to make. So if the personal allowance, let's just use that as an example, had been going up the whole time by inflation, so it's been frozen for a while, it's going to be frozen for a while. That personal allowance, depending on what inflation, it would be a lot higher. And so this affects everybody, especially affects people, that don't earn very much money, where that extra tax that they're going to have to pay just makes a huge difference.
Well, it does. So we should talk about probably the context of the country and the state we're in. So we're underproductive.
Yeah.
We don't earn enough money.
We're all doing podcasts.
Everyone's doing podcasts.
Drinking tea. We're the problem.
That might be true. But yeah, there probably is a correlation.
Yeah, that's it. Productivity and podcasts.
Yeah. Or TikToks or something.
That's it.
We owe a lot of money.
Yeah.
And the cost of paying that debt is where a lot of our money is going from. That's what the tax increases are largely for. But also trying to make things better.
Mm-hmm.
Better too, like our public services and things.
Yeah.
So some of this money is going to be paid on, that's being raised is going to extend child benefits, so take away the 2-child cap, and be spent elsewhere, which may or may not be good, depending on your viewpoint. So other tax raising things Rachel Reeves has introduced is a rise in dividend tax. So if you haven't got investments or you don't own a company, probably don't care.
Yeah.
Or even know what it is. So a dividend is a payment of a share of the profits of a company.
Yeah.
And traditionally that's been taxed lower than income tax rates.
Yeah.
So Luke, if you want to explain what the dividend rate rise is and what it means.
Yeah. So essentially, at the minute, like you said, dividends are taxed slightly lower than income tax. And what's going to happen from April 2026 is they're going to go up by 2%. Now, that 2% is for the basic and higher rate, not the additional rate.
That's weird, isn't it?
I don't know what that's about. I can't work that out.
Because there must be people getting paid millions in dividends, where that additional rate, that's not gone up. Where it, they wouldn't notice.
So we get our conspiracy hats on here.
Well, this is where, is it a conspiracy? There might be a good reason.
I can't think of a good reason. Like you said, there's some people that are super wealthy that will make serious amounts in dividends every year. And you're right, they won't pay any extra. And when we come to look at the savings and property, that's gone up on all bands.
Yeah.
So why hasn't the dividend one?
Curious.
Tinfoil hat.
I wish we had some. Why don't you prepare that?
I don't know. I didn't think about it. Next time.
It's because you're trying to be productive.
That could be a new segment on the podcast.
Yeah, so dividends, if you've got an investment in like a general investment account or own some shares, or if you're a business owner, so a lot of business owners will pay themselves dividends rather than salary because the tax rates are slightly lower.
Yeah.
So this does affect business owners.
And also on that, like business owners, it's always that balance as to whether you pay yourself salary or dividends. So it'd be interesting to see how that impacts things from April. Might be worth
how that changes.
Yeah, that's it.
I mean, I might change how I do it.
Really?
I've thought about this over the weekend.
That's it.
But also because of what I'm planning. Okay, so other things then, so that sort of link with this is cash ISA reduction. So at the moment, it's 20,000 you can put into a cash ISA or a stocks and shares ISA.
Yep.
And that's been reduced if you're under 65 to 12,000, hasn't it?
Yeah, yeah, it has. The reason I was shaking my head is I am under 65.
What were you dying to pay into a cash ISA?
No, I'm not. But I don't know.
It better not
Just
be.
feel
That means I've taught you nothing.
No, that would be bad advice. No, I don't know. Just why? I know why, but why the split?
So they're doing that because they're trying to encourage people to invest more in higher earning assets like shares, which is good for their country if they invest in UK shares, which they haven't put any sort of minimum or limit on. And so then people get wealthier, don't they? Because they've got more money. Okay. Yeah. So I think what's fundamentally important here is if you've got investments that aren't in an ISA and you're getting paid dividends and your dividend rate's going up, you need to make sure you're using your ISA allowance on where it's going to save you most money.
Yep.
And it's going to save you most money if it's got shares in it, because that's what earns most over time.
Yep.
So use that. So we would discourage any use of cash ISAs. Have money in a bank to spend, and any other money, put it in an investment.
Yeah.
Where it'll earn more. And typically, cash ISAs, they pay less than savings accounts.
Yeah.
So
That's it.
stocking up on them's not great.
Yeah, well, like you kind of alluded to there, the thing that I kind of understand where they're coming from with this change, but why not go the extra step? Like, why just in stocks and shares ISAs? Because if you've got a well-diversified portfolio,
we love a well-diversified portfolio. Yes,
based on how much each economy makes up of the world economy, you're not going to have very much in the UK. So, what difference is this really going to make?
Yeah, I think, if they said, look, you can have this amount of ISA if ISA allowance if you invest, I don't know, in the FTSE. Look, most of them and the FTSE 100 are based abroad.
Yeah.
But it might be in the smaller company side.
Well, that would make sense. That would achieve the goal they're trying to get to. This, I'm not sure it does. But
well, never mind.
Sorry.
That is not for us.
No, it's not.
Because we're not in government.
No.
And that's because we spend our time sitting around with tinfoil hats on.
Yeah. That's...
No, we don't. Tinfoil is for jacket potatoes, and that's it. And then you take it off so you get a crispy skin.
Or fish on the barbecue.
Oh, yeah. Well, what are you doing that for anyway? But that is another use.
Yeah.
Okay, so VCTs.
Yes.
What's a VCT?
It's a venture capital trust. Essentially, what this was introduced to do is to, like we've just been speaking about, actually, try and get more people investing in smaller UK companies. So how it works is you invest in this type of fund. They then invest in small UK companies. It's really specific what they can or can't invest in. And for doing that, you get 30% tax relief. So if you invest £1,000, you'd get £300, knocked off your tax bill at the end of the year, essentially. So like I said, introduced because, small growing businesses in the UK, that's what they want, growth.
They need funding.
Yeah, absolutely. At that stage, they don't have very much money, or it's more difficult to get funding. So let's get people to do that themselves, and that's what it was introduced for.
And that raises money for the government because successful companies employ people, then they get corporation tax, income tax from the employees.
That's it.
So that 30% is being reduced to 20%. So there's still the incentive to do it.
Yeah.
And they still grow capital gains and income tax free.
Yeah.
But it's just that reduction in tax relief. So here we've got three things going on that really affect business owners, I think.
Yep.
You've got the loss of salary sacrifice. So as a business owner, a lot of the people we deal with, they'll be paying in, up to 60,000 a year from their company into a pension. So they're making an employer pension payment.
Yep.
And then there's no national insurance on that. There's no income tax. And it's deductible for corporation tax. So it's getting money out of their business into their pension where it can then grow tax-free. So from April 29 on, that national insurance would apply of 15% employer national insurance, and depending what you take elsewhere, your personal national insurance as well. So that'll be a minimum of extra 2%. So that's going to affect them. Then they might say, well, I won't do pension payments now. I'll withdraw my money out as dividends.
Yeah.
But my dividend tax rate has gone up 2%.
Yeah.
But not on the additional amount. So if they're already taking a lot, it might not affect them there.
Mm-hmm.
And quite often, business owners will draw money out of their business because they're a small company, and they'll invest in VCTs. So they go, well, I don't mind paying 34%, say, dividend tax rate, because if I invest it in a VCT, I'll get 30% back.
Yep.
And that's in other small companies just like mine. So that seems a good way of doing it.
Mm-hmm.
But now that's going from 30 to 20%.
Yeah.
So a lot of business owners will be affected by this, and what to do. So perhaps need to look at that.
Well, it's a big That's a big reduction as well from 30 to 20, knocking a third off. That's definitely going to put people off doing it.
But also on VCTs, they've expanded the amount you can invest in them.
Mm-hmm.
So to be a qualifying VCT, the rules have got wider.
Yeah.
So they could raise more money, but then will as many people want to do it with less tax relief? Who knows?
That's it.
Only time will tell.
And if less people do it, then that's potentially counteracting the whole point, right? To try and promote growth, small businesses coming through.
Well, that's it.
It seems odd to me.
That's it. That is the big thing. So that's what's happened. We're going to leave property till last. Let's talk about what didn't happen.
Yeah, okay, I like that.
With pensions.
Yeah.
What didn't happen that was supposed to happen if you'd read the papers for months?
No.
For 6 months prior.
No changes to tax-free cash.
Woohoo!
Hooray!
Which isn't a surprise to us.
No.
Because they only changed it 18 months ago.
Yeah.
They're not going to do it immediately.
No.
I would have thought.
No.
So very unlikely. And it never changes. Like every budget is always the same. They're going to reduce it. But also, I don't think they would have reduced it to people that are not of an age where it matters. Where you can withdraw it.
Yeah. You wouldn't have thought so. Because you're planning to use that money. So people use that money to pay off mortgage or whatever. If you suddenly cut it like immediately, which is what people are worried about, like they're going to say tomorrow it's this, then you're leaving all those people,
So they might have done it for like if you were, I don't know, 47, say.
Yeah.
Because that's 10 years before you could withdraw it.
Yeah.
And then you've got time to earn the extra money, haven't you?
Yeah.
And put it away. But for people where they can just take it out, I just can't for the life of me see why they would do that, because that would affect mortgage companies for the reason you've just said. There's lots of interest-only mortgages. People set up to repay a lot.
Yep.
And it doesn't give people time to put it right, which is what the government are all about, hopefully. Giving you time. Yeah, so I was well confident that wasn't going to happen.
Yeah, and every year this is, isn't it?
Oh, every year.
I don't know if that's coming from politicians or just coming from newspapers, probably just newspapers. But it's a story that's going to get clicked, like we said already, like every time. But it's just to panic people, and people make huge mistakes on this every year.
And also big changes, I think. It's not just it's not like a rate change on a dividend or something. That's easy to implement. If it's a big change, think of all the pension companies that have to comply with it.
Yeah.
After so recently doing it anyway.
Yeah.
That's a lot of administrative work, and thought needs to go into that. And when you got a productivity crisis, people were already busy making their podcasts and stuff. You don't need something like that to come and spend thousands of hours trying to work it out.
Agreed. Well, look at the other thing that didn't change with pensions, which is the inheritance tax side of things that came in last time.
Yeah.
They give themselves a massive amount of time to get those changes done, right? Because it's a massive headache for everyone involved.
Because it's complicated.
Yeah, exactly right.
It's easy to say it's one sentence, but that is thousands of hours of work. Anyway, that was good. I like to be right. That was good, wasn't it?
It was.
We were high-fiving
Well,
about that.
I don't know.
Okay, so let's talk about property.
Yeah.
Property investors, how will they be infected? Not infected. Well, they might be infected with over-enthusiasm due to programs like Homes Under the Hammer, for example.
Yeah.
But how are they affected?
Well, so the tax rates on property are going up by 2% on all bands.
So the same as the dividends. They're going from 20% to 22.
Yeah, 40 to 42 and 45 to 47.
So that's an extra 2% on income earned from rent. Okay.
And when you it's a buy-to-let property, that's a job, isn't it? That's a job, or you're running it as a business.
Yeah.
That's an extra 2% out of your margins. And I think what we've seen is that over time, having rental properties, has got worse and worse. And I don't know about you, but I'm seeing a lot more people questioning it now.
Well, there's extra stamp duty when you buy one, isn't there?
Yeah.
Taxes are higher than like you can't put a property in an ISA or a pension, a residential property.
Yeah. It's not, more people struggling. So I think more people having problem with tenants and things like that. That makes a huge difference, doesn't it? It's not. It's all fun and fine.
Oh yeah, there's potential changes, isn't there? Or have they happened?
Kicking
like where you can't evict people as easily.
Yeah, it's more difficult. So all of these things, culminating together, and on top of that, interest rates going up. So if you're mortgaged up, your mortgage costs are going to be higher than they've been before. So all of these things, I think, are hitting landlords pretty hard.
So purely from a financial point of view, I don't get why people would do it. So just for financial planning, if you want 10 grand, get it out your property within a week. You can't.
Yeah.
Right. You might be able to get some borrowing, but it's going to take a lot longer than that. I find people hold these rental properties and they get older and older, and it's more and more complicated, and then it's too complicated. That's how brain capacity decreases over time.
Yeah.
It's too complicated to sell, so they're stuck with them all their life.
Yeah.
And it's a job. Like, you're having to do stuff, even if you pay someone to do it, like an agent or something.
Yeah.
And the growth rate on property is lower than shares on average, right? So if that's the case, you're earning less, but you're paying more tax on it. You can't protect it in an ISA or something.
Yeah.
And it's illiquid. So if you want your money because you want an opportunity comes to buy something and you need 50 grand urgently, you can't do it. So I don't really understand why people do it. And it just, I think that's just getting worse and worse over time. Now, for your personal home, a new thing's been introduced, which is highly unusual and is probably, not to say sexy, it's the most different thing, but it's the most different and unusual thing that's been introduced for ages, and that's a mansion tax.
Yeah.
So tell us about that.
So this is an interesting one, wasn't it? There's lots of talk before the budget about this and stamp duty and things like that. So essentially, there's going to be a new tax on properties that are worth over £2 million. I think it's going to be done through like council tax bandings. So 2,500 if it's over 2 million, 3,500 over 3.5, and 7,500 at £5 million.
So is this a forerunner of a wealth tax?
Well, it's not too far away, really, is it?
No, it's easy to implement because
Yeah.
it's just using council tax stuff.
Yeah.
And it's like a little nibble, isn't it?
That's it. So how far away? It's one step towards it, isn't it?
Yeah,
potentially.
So these aren't necessarily massive houses. You think of mansions, but in London, flats are £2 million.
Yeah,
I mean they're nice flats.
Yeah.
But it's still flat.
Yeah.
Right? They're £2 million, so they'll be paying extra. There's an issue about people that say that is your wealth and you've been in that house or home for 30, 40 years or something, and it's just grown a lot in value for whatever reason. You might not have any spare money to pay it. So asset rich people, but haven't got the cash flow. So do you think that people might move, or we could use equity release to help pay these costs, I guess?
Yeah, it's an added incentive. I mean, like you said, the amounts you're talking about here aren't huge, but if you haven't got them,
they're huge if you haven't got it.
If you haven't got the money, yeah, absolutely. And you often find that you don't want to move out of the nice family home.
Yeah, all the memories and stuff.
because it's difficult, but sometimes that is for the best. So if you're struggling to live, even if that's in a £2.5 million house, you're still struggling, aren't you? Whatever way you look at it.
Yeah. So, okay. So those are the main changes that we thought about that we think are going to affect most people. I think business owners are the most largely affected, but I just want to take a few minutes to just look at when these changes are coming in. So the dividend tax increase, the VCT relief cut, they're all coming in from April 2026. So next tax year makes sense. We haven't talked about this, the 2% additional amount on savings tax.
Yeah.
So the extra 2% income tax effectively on your savings interest and the rental property income is from April 27, as is the cash ISA reduction. The mansion tax is from the 1st of April 2028.
Yeah.
And then salary sacrifice is from April 29. So a lot of this is being delayed, isn't it? Why do you think, Luke, they've done that? Some of it will be because of just because it's hard to set up.
Yeah.
Do you think there's any other reasons?
Where's that tinfoil hat? Yeah, absolutely. I think by doing it later, it helps to effectively soften the blow, doesn't it? If it was all coming in immediately, well, not immediately, but say in April, and you're feeling it all straight away, that's a tough pill to swallow, isn't it? But gradually being brought in over time,
not really noticing.
Yeah, just little by little, slowly. I was going to say getting worse, but slowly being taxed more over time, you don't notice it, do you?
Yeah.
It's like losing weight.
I've never noticed that, to be fair. Is that even possible?
Or, those kind of small incremental changes in life and in tax, over time, you don't notice it. And then suddenly it's like, well, hang on a second, I'm feeling way poorer than I was before. And it's because of this building up over time.
It's like creep, isn't it?
That's it.
So similarly, that's why people don't save in pensions quite a lot, because it's so far away. So this is something called hyperbolic discounting.
Ooh. We're not just jokers here.
Yeah. We know words. Yeah. Hyperbolic discounting. So that's where you discount in the future the effect of it, essentially, in today's terms. Say, it's not as bad.
Yeah.
Because it's way away. And that's because that's all due to our evolution and how we need to survive today. We're not worried about 4 years' time or 3 years because we've got to get through today. Yeah. Which, after listening to this podcast, you might be worrying whether you are able to get through today.
But that's true, isn't it? That's true in every bit of life, isn't it? Always not worrying about tomorrow or, could be anything, couldn't it? Like people that smoke, that it's bad for you, but it's tomorrow's problem, isn't it? You're going to be okay today, so it makes it more difficult.
Yeah, what do they say? Every cigarette is 2 minutes off your life.
Yeah,
but that's 40 years away.
Yeah, it's not 2 minutes now, so I'm not going to worry about it.
Doesn't matter.
That's it. And funny enough, that's why these incentives, like the salary sacrifice incentives and things like that, to get people to think further into the future are so important, and why it's such a big thing to cut those back, because people will do it less. Absolutely.
Also, interestingly, they're not introducing that, which is probably the biggest one, until election year. So probably after they call an election. So it could be them or the Labour government now. It could be whoever.
Yeah.
Whoever gets in at the time. Right. So I don't know if that's naughty, if it's political.
It is political. Probably a bit naughty.
So anyway, let's do. So what's come out over the weekend is that this black hole we were in actually didn't exist.
I know.
It's like, how hard is it? Is that a bit naughty?
Well, I mean, we don't know exactly all the details yet. But if that is the case, then yeah, it's absolutely naughty, isn't it? Because it's selling the story. We're all struggling. We need to, the government hasn't got enough money. If we don't do this, think of, like you said before, taxes go towards helping people, supporting people that need it. And that kind of story of we haven't got enough, we need to all chip in and help is a powerful one, isn't it? Because most of us, I think, are like, yeah, well, we do want to help. And so it's an easier sell then. But if that isn't the case, it kind of comes back, why are you doing it? I think.
Well, that's it. So normally at this point, we would do Sockology, where we look at socks of a listener or a viewer or ours and say how that affects our mood. But today, we're ditching that segment, right? A, because I'm suffering a flare-up of gout. I don't want to get my foot out because it's huge.
Nice.
Right. And B, we're all about tinfoil hats today, aren't we? So what we're asking listeners and viewers is if you send in your best tinfoil hat, put it on with a picture of you grinning in a bit of a funny manner.
Yeah.
The winner of that will send them something nice.
Oh, okay.
A little present. Okay, so you need to email that to info@lucentfinancialplanning.co.uk. That's info, I-N-F-O, at Lucent, L-U-C-E-N-T, financialplanning.co.uk. Okay, and then we'll do a live draw if anyone sends any.
Yeah, it's live draw 1 of 1.
I really hope they do. Now, because we do have a lot of listeners that never comment or leave reviews. Leave us a review, people. It really helps.
Yeah.
It's nice when you mention it in meetings and things. And quite often, it's people I would never expect to be listening.
Really?
Yeah. Yeah. I'll need to tell you off air.
Yeah.
Someone. But yeah, it's quite amazing. So, fixes to the budget. Well, there aren't any fixes really. But
No.
what should we focus on now? Because these are all just tax rises.
Yeah, I think the kind of main thing is using them, because some of these are being delayed, using them while you still can.
So whilst you still can, business owners especially, lump into your pensions.
Yeah.
Whilst you're getting that relief. Remember, any unused allowance you can carry forward.
Yeah.
There's only any point if you've got the profits in the business to do it.
Yeah.
See us and we can work it out for you, the best amount.
That's it. And like a wider message would be like, think that going forward. I know you said earlier to do nothing, but when you've got advice, you can do something. But we tend to again kick that can down the road. Oh, I'll do that next year. I'll use that next year. But what we've seen is that some of these are being not closed, but certainly made worse, like pension contributions, VCTs. Look at capital gains tax exemption, how much that's been cut in recent years.
That's gone from 12,000 to 3,000.
Absolutely.
So people are going to have more money in these general investment accounts because they can't get it into ISAs and things quick enough.
And apart from pension tax-free cash, nobody seems to realise that those kind of things, those changes happen all the time. And that great thing that you're doing at the minute, like pension contributions and how tax efficient that is, doesn't necessarily they're going to be there forever. Get on and do something about it.
Make hay while the sun shines.
Absolutely.
It's very easy. Just do that and do everything up to the maximum if you can afford it, right? And it doesn't affect you in the short term.
Exactly.
Right? Don't ask questions. Do it. Don't think, oh, this might happen. Don't second guess. Do it. And you might be wrong sometimes, but you'll be more right more often.
Absolutely.
And that's, our life is determined by the sum of our decisions. That sounds really philosophical.
It does.
I'm going to ruin it now with some.
That's right. Sorry. I
some
thought you were
extra
going to
chat.
stumble on philosophical then, which would have been funny.
Our life is determined by the sum of our decisions, and you're not going to get all of them right. So don't beat yourself up with no one does.
Yeah.
Right? You're not going to get all of them right. We just want slightly over half, and then we're winning.
Mm-hmm.
Right? And if you keep getting slightly over half, you'll be fine. 60%, that'll do. Won't it?
Yeah.
Okay. And how you get those right is doing things that you can, making hay while the sun shines, not trying to second guess politicians. I mean, they second guess themselves. They don't know what they're doing till the morning.
Yep.
My God, you wouldn't want to be that person who accidentally released it, would you? Unless you did it on purpose. But
Brutal, wasn't it?
God, the heart in the mouth stuff. Oh,
Yeah. Really bad.
Sympathies to them. I feel sorry for them.
Yeah. I mean, and getting them properly getting thrown under the bus as well, aren't they?
Oh, yeah.
You know.
Hounded. Because it is probably quite an easy mistake. Is it? Is it like sending an email to the wrong person or something?
Probably. I don't know.
It doesn't really matter in the end, does it?
No, it doesn't matter.
Like an hour or two.
Yeah.
So anyway, to that person, have a nice Christmas. Don't beat yourself up too much because you're taking enough off everyone else. So it's life. So some of our decisions do it based on facts, not what rumours and scaremongering might be out there.
Yeah.
Okay, so we're just going to go to a short segment now about reviews.
Steve and Jess would be really grateful if you'd leave them a review on wherever you listen to your podcasts. If they run a star system, please give Juggling Mind and Money more stars than the Milky Way.
Okay, so please leave us a review. Any listener or viewer, anyone who's accidentally heard this by mistake. And not just a star rating. Obviously, you're going to put 5.
Yeah.
Because, you're intelligent people. You've heard the word hyperbolic in this podcast, which is pretty good. Not just stars. You're going to give us 5 stars anyway, but something. Write it down.
Yeah.
Send us a review. Write it down. You can, when you're sending your tinfoil hat in for that competition, and we'll send you a prize if you win. I'm not saying that'll be a good prize.
A prize.
Be a prize. Send it in and we can read these reviews out, and that really helps us because it gets us up the charts. I think we're like 72,000th best podcast in the world.
Nice. I mean, I don't. Is that good? It doesn't sound very good. Sorry, Steve.
No, but remember, podcasts are the root of all productivity problems in the UK.
That's true.
So,
we're not even productive at that. 72,000 in the world.
Hey, don't be down.
Leave us a review. Steve needs to pick me up because of his gout. He's having a hard time. That's it. Look at his face.
So thanks for listening today, everyone. Do send in any questions you may have about the budget and what's happened, and we'll happily answer them for you. For everyone else who's a client of ours, we're going to be looking at this, especially business owners, because I think you're going to be most affected and what we can do next. But there's no need to panic because most of this stuff doesn't come in for months or years, and we'll just do it over time in our annual reviews.
Yeah.
All right. Thanks for listening, everyone. See you next time.
Bye.
Goodbye. Say bye, Luke.
Bye.
Well done.